But it's nothing to be scared of. When people are selling off and panicking, now's the time to step in. Use some of that cash and put it to work in something that might give you a better, longer-term return.
So we have people putting their money in cash at the expense of putting in stocks. In doing so, they're sacrificing enormous returns.
If you're demanding more than is being supplied, the price will go up.
Little extra we've got in this podcast is yellow and red cards. Because believe me, these two can talk. And yes, I was looking at you there, sir, in particular. Because
I wasn't me talking.
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to The Art of Investing, a brand new podcast to help you achieve your investing goals. Brought to you by IG, the FTSE listed global investing platform with over 50 years in the markets. If you're new to investing or are looking to sharpen up your knowledge over all asset classes, you're in the right place. Join me, Rich McDonald, and my co-hosts, Mark Spice Holden and Chris CJ Fellingham, every Friday, when we bring you updates from the markets and insights from our combined 100 years of investing experience. But what makes this podcast different from all the rest? Well, we are launching our very own model portfolio run by the three of us, and through IG, we have access to thousands of financial markets for you to track our investment decisions. Every week, we'll update you on how the portfolio is performing and any changes that we are about to make. My background is that I was a fund manager at Brevin Howard and then moved on to be head of trading at Credit Suisse. That took me to IG, where I present the morning show each day, weekdays, with Trading Live with IG. And that brought me to meet these two wonderful gentlemen. Chris, introduce yourself to the listeners.
Hi, my name is Chris Fellingham. I'm a veteran of 40 years in the City of London. I've worked for some of the most prestigious asset management firms in the city, including BlackRock and working for Soros. I've invested through a lot of times when asset markets have been good, but also when asset markets have been bad, both bonds, currencies, and equities.
Well, that's a tough one to beat. What about you, Mark Spice Holden?
Hi, everyone. I'm Mark Holden. I'm still here despite working for Chris 5 times in the last nearly 40 years that I've been a professional investor. During that time, a bit like Chris, I've worked for some of the biggest and best investment banks around the world. To name but a few, Deutsche Morgan Grenfell, ABN AMRO, and Standard Life Investments. But my area of expertise comes down to being an equity and a commodity specialist within the teams that I've worked with. And I hope to bring some of that expertise to the team here today. And as we go forward with the exciting new podcast, which I can't wait to get going on.
So for everybody watching on your podcast, you will see that you could be mistaken for thinking we've grabbed these two guys out of the pensioners' queue at the local post office. But they really are my Warren Buffett and George Soros of the UK. And we were introduced a few months ago now. And after spending a 4-hour lunch with them, then I just knew we had to get them on film. We had to get them on record. Just having a chance of the 100 years of experience working in the city between us. I really wanted to get that out to everybody and the lessons that are possible. Chris, what drove you to say yes to doing this?
Rich, I've been very, very lucky that I've worked in financial markets for the last 40 years, and I've seen at first hand the power of the wealth creation that one has been able to obtain from this industry. And we as a society, we need to realise that when we think about retirement coming up, and closer for some of us than for others, Richard, you're going to probably work for 40 years, 45 years, and then you're going to retire for probably, given life expectancy, for maybe 30 years, 35 years. You need a lot of money in order to meet the retirement that you want for yourself. You may want to go cruising. You may want to do lots of other things. You may want to buy yourself lots of gifts. You need to be able to understand about the markets and how they work. And, having thought about that, we've been very, very lucky to find in IG a organization that believes, as we do, that we need to bring this to everybody and help everybody realize their dreams and their aspirations. And we're going to do that. This is the idea, and this is why we're now here. We're going to do that by explaining how the markets work, taking people in detail through how the asset classes move, deciphering what's going on every week and what's important and what isn't important, working towards a model portfolio and helping then individuals see that they can take control of their own destiny, their own investment story, and create a great future for themselves.
That's right. So if people are thinking about their pensions or just their investments, it's really giving themselves the chance of getting to that point of financial freedom. What about you, Mark? What drew you into this?
Well, when I first joined the city back in 1986, a long time ago, obviously, the city was absolutely full of old Etonians, the old schoolboy network, people who had been to Oxford or Cambridge or the Russell universities. And I got a drinking man's degree from Middlesex Poly in North London in accounting and finance. And I managed to talk my way into a job in the city and have been able to work my way through. But at that time, you really needed to come from one of those big academic sort of houses or backgrounds. It was very much an aristocracy running sort of stock markets and the city. I think now, thankfully, over the last 40 years, it has evolved into something that's much more like a meritocracy. It's much more inclusive. You see a lot more women in the jobs now, which is great to see. And thankfully, like I say, you are now judged on what you bring to the party rather than where you've come from.
And tell us, Mark, what do you bring to the party as our equity specialist?
Well, I say, I've invested in many different sorts of funds over the years. I've been an income fund manager, a growth fund manager. So I've been hunting around for dividends, and I've been out trying to find those great cutting edge growth companies. And I've been able to bring that from a bottom up perspective, understanding how companies work, and then understand how they fit into markets at different times. And the markets go through different cycles. And of course, if it's sunny outside, you want to put your sunglasses on, put a pair of shorts and a t-shirt on, and out and enjoy it.
Please. I'm beginning to think
you won't be seeing my shorts just yet.
Yeah.
And so I used to sort of invest like that. But if it's snowing, you want to go out with a big coat, and there are certain stocks and certain sectors within markets that are good for those sort of conditions. And it's understanding how they work within markets. Those are the sort of companies or stocks and sectors that you want to go after. Now, we're not going to be talking here about individual companies very much. We're going to be talking about the big indices that are around the world, because that is probably some of the safest ways for you to invest your money. If you buy individual companies, you get much more specific risk. If the chief executive, God forbid, gets knocked down by a bus, then the share price could easily fall 20% if he was rated very highly, or go up if he was considered very poor. And so we want to try and take some of that risk away by investing in the overall stock markets, like the S&P 500, like the FTSE 100, and many others that you'll come to learn about in the future.
And this takes me to the real jewel in the crown of this podcast. I didn't want to just deliver another one, right? There's a new podcast coming out every single day. I wanted a financial podcast that was considered the best in this country. And how are we going to make this one different from the rest, Chris? What's the one difference?
But we're going to put it into action by creating our own model portfolio. So we are going to build up over the next few weeks to the creation of a portfolio which we will be running as a long-term investment vehicle to meet the aspirations return that we're looking for. We're going to set that return at 10%. So we're going to be looking to make 10% per annum, whether markets go up or whether markets go down. And we'll be able to show how what we're discussing in the podcast feeds through to the decisions we make on the portfolio. And hopefully then help educate the people who are watching the program to see why we're doing things, understand why we're doing them, and help them then take control of their own investment story.
And that's the great thing. So this is going to be powered by IG, by the IG platform. They've got thousands of financial instruments available. And we're going to go through each week what's happened in the markets and then a hot topic of the week. And we're going to take your guys' thinking and see how that develops into switching the portfolio around. Is it going to be a big switch? Is it just going to be tweaks? And that's what we're going to be looking at every week, which I am very excited about.
But I would like to say, in order to do that and to fulfill this education process, we're going to need to talk in detail about all the different asset classes that we can consider and when they work, when they don't work, and how we're going to be positioned in them. And then people are going to be able to see how that all comes together to give them the confidence to go and do it themselves.
So, shall we dive into it? What about taking a look at what has been happening recently in markets? Spice, we are at all-time highs in the S&P 500, in the FTSE, in the German DAX, even in Bitcoin. What has taken us there?
Well, there's no such thing as a dull week in markets, is there? And, the dawn across the Atlantic certainly hasn't let us down. There's been a huge amount of information come out, not least the world's biggest central bank, the Federal Reserve, released their minutes. And in there, they gave hints that we're getting quite close to a new interest rate cutting cycle in the US. Now, that's very important for asset markets. It does tend to buoy them up. There's nothing better for particularly equities than seeing an economy that's stable and then seeing interest rates come through as well. That's great for equities and powering them. And it helps part explain why equity markets are at all-time highs.
And we will be going into that in later weeks, a real deep dive into bond yields, interest rates, and why that, as you say, is such a positive for it.
Absolutely. But what we took from the last minutes this week was that actually they've got a meeting on the 31st of July, which is one day before the next tariff deadline that Trump's put in place. But we don't expect any cuts there. But however, on the 17th of September, which is their next meeting, there's now a 67% probability of a rate cut starting there. And then over the next 12 months, you expect to see another 4 or 5 rate cuts from the Americans. And they've been lagging behind what's been going on in Europe and even the UK, where we've been cutting already. So that was very positive, helped push markets up. Obviously, the other thing is that Trump managed to once again pull out the taco trade and kick the can down the road when it comes to tariffs.
Explain what you mean by that, Mark.
Well, to be fair, the
Oh.
Financial Times, I can't take credit for this, but the Financial Times coined a wonderful saying, which is Trump always chickens out. Taco. And I'm sure he's fuming about that.
I'm sure no one dares say that to his face, although I think a journalist did, and he got very angry.
Absolutely. I think he's banned the FT from some of his meetings now. But the FT is great when it comes up with that sort of thing. But nevertheless, it's proof that actually since his first Liberation Day sort of revealing of the tariffs, where it shocked lots of people, it's been right to buy the negativity on that every time in the stock markets, and they've gone up and gone much higher ever since.
Yeah, 24% rally in the S&P 500 from the lows of that Liberation Day.
Absolutely. So he tried to threaten people again. He said he's sending out 12 threatening letters to other countries. But frankly, there are only 3 that haven't come to a trade framework deal yet. That is Japan, the European Union, and South Korea. Those are the only ones that really, there are lots of others, but the ones that really matter for stock markets and investment markets are those 3. Now, it sounds like the EU are very close to doing a deal. Japan probably won't be far behind, and South Korea will do their own thing. But they're all linked, those 3 countries are all linked to very big automotive industries. Trump has put 25% tariff on all cars coming in to the US from those countries.
Do we have any idea when they're going to be? Some of those might be announced, the European one, for example.
The European one should be by the end of this week. So probably when this podcast is coming out, hopefully there'll be one out there. But that's the one that sounds closest. I think Japan is proving a bit more problematical because the Japanese are digging their heels in a bit. And rightly so, they've got to fight back against this guy from time to time. And who knows? But I'm sure they'll come to some sort of agreement. They always do. And if they don't, the markets in Japan will go down 2 or 3%, and then they'll bounce back up again. I think it was illustrative, actually. Trump put in yesterday a 50% tariff on Brazil, totally out of the blue. Brazil was meant to be a 10% tariff, as we've got in the UK, and he put a 50% tariff on.
Which was a political move, and that's, I don't think we've seen that before, have we? Tariffs used as a weapon?
Not really. I mean, you could argue all tariffs are a political weapon, but at the end of the day, it shocked people. But I think it was interesting to see how their markets and their currency reacted. So their currency fell 3%, which partly offsets some of the tariff increase, not the 50% that he's talking about. And then also the stock market fell about 2% yesterday. So if that's a 50% tariff, then actually we don't really have a great deal to fear if other countries get hit with a big one, for example, in Japan or even in Europe. So, I think that was a sort of a marginal positive to be taken out of it, even though it came out of bad news.
Now, a further little extra we've got in this podcast is our yellow and red cards. And I think you were sailing close to the wind there, because believe me, people at home, these two can talk. And so I felt I needed a way of controlling. And yes, I was looking at you there, sir, in particular, because
I wasn't me talking.
Our first lunch together was 4 hours and our second lunch together was 7 hours. And I don't think there was a quiet moment. So if I feel that these two are going on a little bit too long, they will be shown a warning. And if they continue on, then there will be a sin bin action. So don't you worry, people at home. I will be keeping on top of this.
And who's saying it to you?
Yes.
I will just keep those out of your reach, actually. Now, we talked about tariffs, and of course, tariffs feed into inflation. Inflation dictates interest rate policy. So from my bond expert, do you have a little bit to add on what's going on at the moment?
I got a couple of things to add. The first thing I would add is looking at things in a broader picture still, just for the risk of a yellow card. There's an expression that an equity bull market climbs a wall of worry. And so while there is still things to worry about, I think you can be reasonably confident that equities are set fair. So when Trump moves his tariff date to August the 1st, that gives you more runway still to push these prices higher. It will be very interesting to see what happens on August the 1st. And if we can get there and all the deals are in place, and then you're going to wonder what else is bearish out there. And in fact, is everybody going to turn more bullish? So I think you can stay safely looking for markets to rally for the moment, but let's be careful about when we get there, because we are up at all-time highs. Things have done very, very well indeed. It's been a great year for investors generally.
I think just to pause there, you mentioned bullish and bearish. Can we just teach everybody that doesn't know where those terms come from? It is, of course, the angle of attack, because a bear attacks from above downwards and a bull attacks with the horns up the way. Those terms have been used since the beginning of markets, right?
And there's statues of them outside Wall Street. So they are used as characterizations of the types of market that you're in. And essentially, as an equity person, you spend most of your time in a bull market. Prices are going up. As a bond person, you spend most of your life in bear markets with prices going down. You mentioned bonds. If you'll let me just mention quickly bonds to people. We're going to spend one of the sessions coming up, one of the future podcasts, talking about bonds in detail, because bonds are extremely important for the valuation of asset markets. They feed through in every way. They're complicated to a degree, so it will take some time, but we are determined to help people understand them so they can see why you should be looking at where bonds are. The good news for most people is most of the time bonds are really boring because they don't move very much. And actually, at the moment, they are being quite boring. They're allowing the politicians to play fast and loose with with fiscal policy, with borrowing lots of money. Because remember, it's the bond markets that provide the money to the governments to spend it.
And just say a little bit more on that, please, Chris.
Yeah, of course. So if you take a country, you look at its outgoings and its incomings. Its incomings are tax receipts. Its outgoings are what it spends its money on. And you will have heard many commentators talking about the big budget deficits that we have around the moment. What a budget deficit is that you're basically spending far more than you've got coming in. So you've got a financing gap. And the bond market walks in to fill that financing gap. It's an IOU. You lend money to the government. The government says, I promise to pay you back that money. And they pay you a financing fee, the coupon, the dividend yield, as you were talking equities, the income you get, and you get your money back at the end. So bonds are very safe, very stable. Now, there's lots of different sorts of bonds. We will be talking about those in another podcast. But bonds at the moment are accommodating all this borrowing. Mm-hmm. Yes, we are seeing some pressure on those bond markets, but not enough yet to unsettle the equity markets. So if I was to look around at things, I said earlier that you've got an equity bull market, you've got things to worry about in tariffs, you're not worrying about the bond market.
Okay, well, that's good to know, because we can worry about equities, we can worry about bonds, but also we're going to talk about commodities, such as oil, such as gold. But there's been a story in one commodity this week that has caught your eye, isn't there, Mark?
Well, absolutely. I mean, Trump came out of the blue. We knew he was assessing a potential tariff on copper. And he's put a 50% tariff on all copper being imported into the US. Now, you may think that that is shooting yourself in the foot, which it probably is, given that America consumes about 13% of the world's copper, and about 7% of it comes from their own copper mines across America. So they have to import another 5% mainly from Peru, Chile, Canada and Mexico are the main places they import it from. And though that copper is going to have an extra 50% put on the price. So if you're a US manufacturer, you're going to be fuming about that.
And what industries does copper especially important for?
Well, it's particularly important for electronics, electrical wiring, and phones, computers, etc. It's a conductor, major electricity conductor. It's the most efficient one out.
And for the Green Revolution, of course.
Absolutely. So, but the biggest consumers are wiring and electronics. The next 20% goes into construction. If in your house at home, you've got hundreds of meters of electric wires that are copper wires.
And this is why the railroads have to watch in particular when the copper price goes too high, because there's people come up and try to tear up the rail tracks.
Yes, that's why there's not much lead on churches around the UK, because when the lead price went up, everyone went and stole the roofing from churches, sadly. I wasn't one of those people, obviously, because I want to go to heaven. But
of course, you won't do that. Not a chance.
And when it comes to having a diversified portfolio, then we are going to look at all these things, aren't we? It's not just going to be an S&P 500 tracker or the FTSE 100. We're going to look at gilts. We're going to look at treasuries. We're going to look at copper, oil, gold. And I think that takes us very nicely into our hot topic of the day. And that's a report from JP Morgan, the mighty house of JP Morgan. Chris, run us through what it's trying to get across when it talks about people's portfolios, their ISAs, their SIPs, and their savings.
Okay, so first of all, a little shout out, as you say, to JP Morgan Asset Management. They did a paper about 3 weeks ago called The UK Savings Opportunity. And it was a really, really interesting report summing up where we were in the UK with regard to UK investors' savings. There were 3 main takeaways that I found.
Okay, so the question was, where do you think gives the best possible returns for your long-term investing in your retirement?
Correct. And so there's the chart, as you will see, if you've got it in front of you. If not, I will describe. The most important bar on the chart is pension funds, and that's about 26%. So we should be really grateful and happy that people have realised that for retirement, a pension fund is a pretty good idea. But I am rather concerned that 74% of people didn't answer that question in that way. What concerns me even more was the second bar, which was don't know. And don't know was 25%. So 25% of people hadn't got a Scooby-Doo what they should do for their long-term investment vehicle.
If ever we needed a underlining of the reason why we decided to do this podcast.
Correct. The third bar was property at 20%. So obviously property is very important in the UK, and maybe we'll talk about that in a moment. At 10%, you had easy access cash savings. So far, we've done nothing apart from the really safe traditional ways that we would expect. Stocks are down at about 9%.
Wow.
Cryptocurrencies are at 4%. So stocks are only just above cryptocurrencies, and government or corporate bonds are down at 3%. So you can see from those numbers that we are a long way away from people realizing what the alternatives are for where they can put their retirement savings.
And why does that alarm you so much? What kind of stats back up the argument that that's wrong?
In this document, they talk about the level of returns since COVID. And they talk about if you held cash or if you held the world stock market index. So they just talk about those two, but I think the conclusions are valid. They look at those returns in a real way. So what that means is, what is the return? And then you take away inflation over that period.
Okay, so every year you can take off inflation from the return.
So
that gives, what do they call that?
So it's called the real return. And the real return is the gross return minus the inflation rate over the period. The MSCI, which is the World Stock Market Index, so that represents all the world stock markets, so all the companies in the world in their proportion relegated, consistent with their market capitalization, has done 39% in real terms over that period. 39% in real terms. And in that period, remember, we have had inflation up to 10, 12, 13% in one particular, if I remember correctly. Cash has done minus 9%. So we have people putting their money in cash at the expense of putting in stocks. In doing so, they're sacrificing enormous returns.
Yeah, that's real wealth creation against wealth destruction, isn't it?
It is. And even more in this document, they then go to the people who chose cash and they ask them, why did you choose cash? One, easy access. Well, hold on a minute. Everything we're going to talk about on this podcast will be easy access. They will be ETFs, stock market indices, very easy for everybody to see what they should buy and how they can deal in them. 25% of them were afraid of losing money. And that, I think, is something that we have to get across and help people to understand, that although in any one particular year, it is possible that the stock market will do badly, all the evidence suggests that over the long term, stock markets produce excellent results. And as you can see, since COVID, an enormously extra result through the world stock market index to cash.
So 25% were most worried about losing cash. Was that the Scots?
It doesn't go down to a geographical breakdown. It certainly would be consistent with the Scots that I know. But hey, I don't know them all, do I? So that I thought was really interesting. They coin a phrase in it. They say, saving is good, investing is scary. And they say that's what they see coming through here. And I thought that's a lovely way of describing from their numbers what you can see coming through. And I think what we need to do as a podcast is we need to get that. We need to change some of this round. We need people to understand that savings is good. Investing isn't scary. It's the right thing to do to get that wealth accumulation over the long term.
There was a great statistic I heard, and it was going back to 1913, right? If you had $1 in 1913, in real terms, by this year, you would have lost over 99% of your spending power. If you put it in US Treasuries, that dollar would now be worth $1.20. Okay, it's kept up. If you put it into the stock market, it would now be worth $1,350. That's the kind of difference that we're talking about over the very long term between investing and between just getting your cash and putting it under your mattress. I bet there's a bit of cash under your mattress, Mark.
I wish. Mine goes on nice bottles of rosé and long lunches with you guys. But talking about the amount of cash in the world, I looked up actually this morning. So in America, you can look up the amount of cash that's being held in short-term deposits and money market funds. And there's $7.4 trillion sitting in these cash funds at the moment. Now, to give you some perspective on that, the whole of the US S&P 500 stock market, which is the biggest stock market in the world, is 55 billion. Trillion, yes. So, look, big numbers, obviously. But so there you've basically got 14% of the S&P effectively sitting on the sidelines. Now, imagine if just some of that money got put to work and put back into stock markets. Stock markets would go even higher. And that would probably be the time that a few grey hairs around this table would say, maybe it's time to start selling it. But now,
I don't
it's
see
still
that
on the
many grey
sidelines.
hairs. I think you're
Ash blonde.
Yeah, the ash blonde around the table might get negative.
Historically, the Americans, and to this day, are much better at investing in numbers. Over 60% of Americans hold stocks, don't they? Whereas it's less than 30% in this country.
Yeah, it's derisory. And I think, that is partly the industry in this country has not been very good at educating people. The government haven't been very good at, and that's whether you're Labour, Conservative, or whoever party you believe in, they should be educating, people about the potential returns in there. Because, if I can pick out some numbers now, but if you go back since the Great Depression to now, equities have returned 9.6% on average each year.
And sorry, that was 1966, the Great Depression, wasn't it? Is that right?
Only if you're Scottish. But since 1928, equities have given 9.6%. Bonds have given 4.6%. And cash has just given 3.3%. Now, as we said earlier on, and you take inflation off of that, and inflation has averaged 3% over that time, cash has only given you 0.3% real, so above cash. Bonds have only given you 1.6% above cash. And by the way, if I was paying a wealth manager 2 to 3% and he was going to give me 1.6% after inflation every year, I'd be disgusted. I would be absolutely disgusted. And one of the great things about the portfolio we'll bring, it's cheap. IG give people access. Anyone can have access to this sort of thing. And it's cheap and easy way to get in, and you don't have to pay a very expensive wealth manager to do it. But the punchline is that equities have returned 6.6%. So far and away, the best average returns. Now, even this in the last 6 months, just think of what has happened in the US stock markets this year. They fell 20%. The S&P fell 20% from Liberation Day, where Trump revealed his new tariffs, 67% on China, et cetera, and they're now bounced from that level 25% higher. They're bounced from their low 25%. So they're higher now than before that, all in the space of 3 months, 4 months. And that is, quite extraordinary. But it's nothing to be scared of. That's what we go back to say. Some of, our experience, hopefully tell people when people are selling off and panicking, now's the time to step in. Use some of that cash and put it to work in something that might give you a better, longer-term return if you've got that time horizon, which we're going to try and hopefully convince people that it is good to have a long-term time horizon when you come to investing.
Yeah. Now, a lot of people's main investment is their house, and we know that property's in there as 20% of people think that that's the best investment vehicle for their retirement. That's very much a British thing, isn't it? Did everybody just play Monopoly when they were a child, or what's given them that kind of viewpoint?
Well, for those of us who've been around long enough, I saw the tail end of Margaret Thatcher coming into power. I remember the mornings I was told that she'd won the election. And she's a very Marmite character, of course, very divisive. You can't mention the word in my family with 3 children. And one particularly lives in Manchester, so they definitely hate her. The Scots will definitely hate her. But what she did for this country was completely change the attitude towards property, because she passed a bill called the Right to Buy. Mm-hmm. So if you lived in a council house and you'd been paying rent for years and years, you could buy your house at an accumulated discount, depending on how much rent you had paid into the state, if you're to a local authority. So people were able to buy their houses, their council houses, from the government, 30% lower than they were valued the very next day in the market. Now, that's what we call in the markets a no-brainer trade. You buy something 30% less today, you sell it tomorrow, and you've got made 30%. Why wouldn't you do that? Now, over the time she was in power, and that was a decade or so, the discounts increased and increased and increased. At some point, people in flats were able to buy flats at 70% discount to what the price was in the market the very next day.
And that was to increase the incentive for them to buy.
Absolutely. Basically, they wanted to get people into the habit of saving, being responsible for their own property, taking that personal responsibility. And it has made this country a lot of money. And, there are a lot of people who are asset rich in this country because they own their own house. They may not have a lot of cash, but they're very asset rich. And they're very proud. People, in the Brits, we like owning property, and this is part of the reason for it. If you go to Europe, people rent their properties.
Yeah, but this has been passed down from generation to generation. And now youngsters don't feel that they've got the opportunity, because you old boys are just hoarding everything. So now it's really hard to get on that property ladder, especially with interest rates above 4%. So the taxes, the additional stamp duty, is there a shift in ideas now? Is there a shift in opportunities maybe that there was back in the good old days?
There were basically two reasons why you could say property was going to be a fantastic investment. One was at the same time as Margaret Thatcher, they were deliberalising the lending markets. So people could have multiples of 4, 5, 6 times their salary. And that would, work well. And then there was a supply shortage. And the supply shortage was people weren't building them. But also we have had quite a lot of immigration that's come into this country as well, which has been creating that a supply-demand imbalance that Mark talked about earlier, where if there's a lack of supply and lots of demand, prices go up a lot. And so people got used to the idea that houses were the right place. Now, if we look at things now, I'm not as positive on property now. I think Mark and I slightly disagree here. But, to me, we've got a government plus all governments saying we need to build more. We're going to try and get that size up. Now, clearly, they're not doing as much as they would want to now, but they're going to keep trying, I would expect. Financing is not as easy to get because mortgage rates have pushed up. Mm-hmm. And therefore, you're going to find a situation where people are looking to offload their homes, especially as well that the council tax has changed on second homes and third homes and fourth homes, where now they're charging double council tax on all those.
Yeah. You
go and look around at the coast now, at the seaside towns, lots of things are for sale now because people are getting charged so much. So I think what you're finding is that balance is turning around. And so therefore, now is a good time for people to think about, well, maybe my house isn't the right place for my investment monies. Maybe I should now be putting that money into the stock market, into the investment markets, which is what we're trying to address here in this podcast.
And certainly that longing to, as soon as you can, get that deposit down on the house. Maybe it should be the longing to build your ISA up and to get that invested and do it the right way and do it in a diversified manner. And I think, again, this model portfolio that we'll be running, people actually see the way that such professionals as yourself have been doing over that time. Mark, was there an opportunity for you to invest in housing? Was there a way to do it through equities?
Yes, you can do. There are lots of different what you call REITs, retail real estate investment trusts, basically. Okay. They're investment vehicles which take all of the income that a property owner gets and distribute it as a dividend, if you like, as income. Right. So there are ways of doing that. But I think, one of the things that the government, that plays to property, which is underestimated, is it's your first house, your main house, is tax-free. Now, what the government have to do is, and we don't want to be political in this podcast at all, but what they need to give you some sort of tax-free vehicle, like an ISA, like a SIP, where you basically are encouraged, but that you can get very cheaply through people like IG, and you can inject other assets in there where they become tax-free. So if you invest continually in ISA every year from when you're 18, 19 or first start work, that'll build up a huge amount of tax-free wealth, which until now people have used in their house because that's been your principal private property. You can sell tax-free. You don't have any capital gains tax on it. And I think that's something that has to be massively encouraged. Sadly, it's not as encouraged as we would like it to be.
Yeah. And Chris, what did you see over the years? Were there some funds that you worked for that were more interested in property or more interested in bonds specifically, or what were the opportunities?
We as an investment industry, if we go back over the years, have always been very, very keen on commercial property. So you will find a lot of the old insurance companies, a lot of the old pension funds will have very large weightings to commercial property. People would say you can't go wrong with commercial property. You buy a property, you let it out. There were upward only rent reviews, which for people on here, you won't have heard of them because they're quite old. But what would happen is every 5 years there would be a rent review on a property, and it was not allowed to go down. So if the worst it was going to stay where it was, but the probability was it was going to go up by X percent. So if you owned an industrial unit, let out to somebody, After 5 years, you say, put my rent up, and I'm going to put your rent up, and then I put it up again, and I put it up again. So people said it can't go wrong. They have been completely taught a lesson by COVID, because COVID, with the changing work patterns of people, moving people away from the office sector, from Amazon and our friends delivering everything, so people don't have to have shops. The commercial property world has had a very bad 5-6 years. I'm afraid they've had their comeuppance, and now, once again, it pushes you more towards these other asset classes. If I had time, just to quickly mention 2 other things that I think are really important here. In this survey, we talked about the younger cohort and what their thoughts were with regard to retirement.
Yeah.
Half of them said they had no plans for retirement because it was too early. Ooh. And of those saving, they didn't need to think about long-term returns because they don't plan on retiring anytime soon.
Well, they won't with that attitude.
Exactly. And they've we have failed. They haven't. We have completely failed to explain what compounding is and how returns compound over time. And therefore, if the earlier you start investing, the earlier you put it away in these strong long-term returning assets and just leave it, the more wealth you will accumulate. I have some examples, but I don't know if I'm going to get a red or a yellow card if I'm going to get them.
Okay, well, let's talk about realistic numbers. Let's say I've got £1,000 to start saving with, and from my salary, I can afford to put in £100 a month. How does that develop over time? Because obviously, as a man in my 30s, I can still start.
I'm sorry.
early.
I'm sorry. Can we have a checking query there?
Just for numerical purposes.
Red card.
Yeah, red card. Okay, so if you have 30, if you were 30 years old, put £1,000 in an account, and you put £100 in then every month at 10% return each year. So nice, easy for people to understand.
Which is what we're aiming for.
Age 60, you'll have £250,000.
250,000 from 1,000.
From 1,000 and 100 every month, compounded at 10%. And that's because every year, it's all going up by 10%. It's all going up by 10%. It's all going up by 10%. That's the power of compounding. If you're 40 and you do that, you'd have £80,000 at 60. So you've gone from 250 to £80,000 by missing that 10 years. Think about it. That 10 years is absolutely critical. That's what we've got to try and get across. And the final one, at 50, well, basically give up. At 50, £1,000 to start with, then 100, you've got £18,500.
Oh, £18,000. And then if you start at your guys' age, then you've got £1,000.
It's a good job we don't do ageism on this podcast. Otherwise, I think I might be writing to HR.
Good stuff. Well, that's been a fantastic introduction. I feel I'm really happy about that. And normally at this time in the podcast, I would be taking the viewers' emails, because what we're going to do is have stories. We're going to have questions from my 2 gurus here. But of course, week 1, we don't have that. So we'll maybe just explain how you can get in touch with that. And that is by writing to theartofinvesting@ig.com. And what kind of things would you like people to email in with, apart from when we should have used the yellow card this week?
I would like people to ask us questions related to, and clearly this will be more relevant as we go further on, but how they form their portfolios. What, given their thoughts on risk, given their thoughts on return, given what we've said in the podcast, maybe a bit more explanation about something so they can, it will help them in that journey. Because clearly all we're providing is a model portfolio of what we would do. Clearly it's up to the individuals to take control of it all themselves, but we want to give them every tool in the armory to help them do that. So any question about anything, we'd love to hear bad investment stories. I mean, I've lost so much money over my life in various trades and various things, and they'll come out of the time. A number of listeners who are listening to this will say he has, and I can take you through those stories as well. Maybe they will write in and talk about, do you remember when? But these are all the lessons we learn, and the reason we've got the grey hair and we're still here. And we want to help people by educating them with those things.
Yeah. And certainly if you have worked with either of the chaps here. We'd love to hear your stories from back in the day as well. So feel free to drop us an email. That is theartofinvesting@ig.com. Mark, what would you like to see come in? What questions do you think will arise?
Yeah, I think things that are interesting, the listeners, more than necessarily what we think they're interested in. If there's a subject we haven't covered, then we'd love to know about it. And even if we don't know much about it at the time, which probably is the case, we will go away and do some work. Because, as Benjamin Franklin once said, failure to prepare is preparing to fail. And so we need to prepare for those sort of questions and, have insights into other parts of the market and new and evolving sort of areas. Like crypto 5 years ago, no one was really interested. Now everyone's interested in it. And, there's been a lot of lessons learned there. Boy, there's been a lot of lessons learned there.
A lot of money lost there as well.
We will undoubtedly talk about that at some point. But actually, the ones that have survived this big sort of sell-off and crushing are probably going to be quite interesting. We may even put some in the portfolio. You never know. But, that's for debate and that will come. But anything that on the edge of financial technology that people are looking at and thinking about would be fantastic to hear about.
What is the biggest bubble that you have seen in your career?
Well, until the crypto bubble burst last year or the last couple of years, it was definitely the tech bubble. I worked through that and I was very fortunate to work for one of the most sort of forward-thinking investment houses at the time was Deutsche Morgan Grenfell. And we were very early on in investing in companies like Arm, which is now a global leader. And that company came out of the BBC. It was BBC's Acorn Computers.
Right.
Arm was started from that in a little office in Cambridge. Ironically, then they sold out to the Japanese. The Japanese then sold it back, and it's now quoted in America, not in the UK. And yet the headquarters are still in Cambridge, in England.
Incredible.
But there we go. But the tech bubble was a bit like the crypto bubble, and there were lots of people trying lots of tricks to try and create value from something that wasn't there.
Yeah,
they were lying about
crypto,
it.
You're talking about all the meme coins and the altcoins,
and Dogecoins and all these other things. I mean, at the end of the day, there'll only be a few survivors out there. These big bubbles that happen out there, and Arm was a big survivor out of the previous tech bubble, but most of them disappeared. And it goes back to what I was saying about supply and demand. People wanted to buy all this technology, a bit like they are going after AI at the moment. But there wasn't enough equity or wasn't enough ways for them to get exposure to that. So people were just inventing things. They had students sitting in rooms pressing return keys on websites to show that they had a number of hits on their websites. They were completely cheating. But it was worth it because they had a company that was going up, 100 times every couple of weeks. And we've seen, that was just mind-blowing. And luckily, we've seen that sort of thing before. And we saw it again in crypto. Luckily, Chris and I saw quite a lot of that and managed to step back from those sort of things.
Yeah. And I think, that's a great thing that we will cover, the risks. It's very easy when we're at all-time highs to maybe forget about the risks, but we are very much going to focus on those. And hopefully over the time period that we're doing these, we will see a bit of volatility and we'll be able to tap in.
But you see, it's not just equity markets that see bubbles. So, for example, if you think about the government bond buying that happened in 2012, 2013, 2014, where they set interest rates at very low levels and then they did lots of buying, they actually set interest rates at negative levels in Europe. I.e., if you put your money in that bond, you paid them
to look
after your money.
See, the
and
Germans
people did
that.
And for a year and a half, bonds were negative yielding. And they've now moved up in yield by about 4%, 400 basis points. You'd have lost 50 to 60% of your money buying those bonds. So the asset classes get into bubbles a reasonable amount of time. I would hope that our grey hair, ash blonde hair of my colleague over there, I would hope that we have seen enough of them to recognise when they're forming. And although we may not be able to say exactly when they're going to end, we know when it's time to take the ball away and stop playing the game.
Now, talking about seeing enough of people, if you have enjoyed today's episode and you want to join us again, then look out for the next episode coming out next Friday in your chosen place to consume your podcasts. Should everybody at home follow and subscribe their new favourite financial podcast chats?
Absolutely, they should.
Definitely.
So if you've enjoyed this episode, please leave us a review and tell your friends, tell your family. And we very much look forward to seeing you again next week. Gentlemen, thank you very much. It's been an absolute pleasure.
Thank you.
Thank you.